Hey, I'm Doug Goldstein. I'm a financial planner, and I am here with my good friend Roger Whitney, also a financial planner. Roger, how you doing?
I'm great. It's an interesting day here in America.
It is indeed. Congratulations to President Donald Trump. I thought it was going to be President Roger Whitney, but who knew?
Who would have thunk it? Who would have thunk it?
Yeah. Next time. Well, a lot of people had a lot of concerns about who had been the presidency, and frankly, I think, and maybe we'll talk about this in a minute, that there is a reason to be concerned, but I think what we should really talk to people about today is, in light of President Trump, what should you be doing about your retirement savings? Is that the topic for today?
I think that's the key. Regardless of who had won, it's what do we do to make a great life?
Okay, so let's get started. Let's put up the first slide. And once again, Roger Whitney and I wish a congratulations to President Trump. But now let's talk about what you should be doing in order to protect your retirement. Okay, here we go with the first slide. Now, Roger, let me ask you to give a little interpretation here, because a lot of times people will say, well, I guess if they're conservative, a Republican president is better for the economy, and those on the other side will, of course, say a Democratic president is better for the economy. What do you think?
I think it really doesn't matter. I mean,
nothing matters. Nothing matters.
It doesn't matter. Well, the chart that we're looking at really shows that. When you're investing, the whole idea is to be allocating your capital to work for you. And although a different president, a Democrat or Republican, may have some differences in policy, generally you're participating in the world economy, which is much larger than even the president of the United States.
Yeah, I think that's a very critical point, that even with executive orders and all this kind of stuff that people like to complain about, at the end of the day, the president, there is the rule of law currently in America, and I expect it to stay, and there's entrepreneurship, and there's the economy, and the president is not someone who can just decide, this is the way the stock market's going to go. I saw a great study that if you had invested $10,000 in the Dow Jones Industrial Average in 1897, all the way up till about 2014, it would be worth $4.3 million, and that's through whoever was in the White House. But if you tried to only be in the market when your party was the president, your returns would have been about $4 million less. So if we look over the long term, I think it really is an issue of just being in it and not trying to predict what the market's going to do based on which party is in office. But let's go on a little bit further, because let's look at the next slide. A lot of times people are going to complain about, well, we have gridlock, and the Republicans try to block out the Democrats, and the Democrats try to block out the Republicans. What do you think? Is that what we're seeing here?
Well, and on the slide, it shows that markets generally do better with divided government. So let's think of some logic here. What is it a business looks for? So investing is about investing in the economy and in businesses, right? And businesses make decisions about what they're trying to accomplish. In order to make those decisions, they want visibility on what the playing field is going to look like. And a divided government gives you that, because you end up having negotiated solutions, so less drastic solutions, and it's more of a unified approach than when we have a unified government, when we have drastic changes because one party can control a lot of the policy of the country. So divided governments generally are really good for the economy.
Well, what about the case where we saw when and again, I really don't want to make this a political discussion, but we did see when the Republicans were willing to shut down the government in order to force Obama, to force his hand. Is that really cooperation, or is that just strong-handedness?
Well, that was strong-handedness, but those are small instances of things happening. I look at those as like ripples in an ocean. I think the important thing to realize is that regardless of whether we have a unified government or a divided government, capitalism and the world economy are still much bigger than what's going on in terms of Washington.
Mm-hmm. Okay, so I think that's a really important point, and that maybe people are getting too up. It's funny, when England left the United Kingdom, left the European Union, the day after the world markets crashed and the sterling crashed, and everyone thought, wow, didn't we see this coming? This could have been an awful. And then literally within weeks, the markets around the world were hitting new highs. And I think one of the things that you have to realize is, even though a presidential election seems major, and certainly this one was a big deal, and there was a lot of I don't, maybe we shouldn't say hatred, but certainly a lot of vitriol that was that we saw in the world of politics. I don't think that is indicative of really what's going on in the world. Because look, the next day we're all waking up, brushing our teeth, and going off to work. So things are continuing. It's a good point that you're making.
One way to think about that, Doug, is like water in rocks. So if we think of world capitalism and the government creating policy, capitalism will find a way. People will find a way to do business and create product and serve people. Just like water will find its natural path based on the structure that it runs through. And I think that that's an important concept to think about when we're investing, is that business and the ability to create products and services to serve people is always going to find a way, regardless of what the rules are.
Mm-hmm. Well, that sort of leads to the next point. Let's pull up the next slide here, which is a lot of times presidents have terrible approval ratings. Don't you think that presumably if the president has terrible ratings, it means that the people are unhappy with what's going on, and therefore I would think that would have a negative impact on the marketplace as a whole. You say?
I think with the advent of 24-hour news, it's a national pastime. We love to hate our presidents and our leaders, which I think has made those numbers even worse. And that's that's one reason why we're at these such high levels of unfavorability, is because we have these two huge voices with very big microphones, and we all get tied up into all that. But again, ultimately, that doesn't influence what's happening in the economy. That's just a vitriol reaction to all the flames that are being thrown on 24/7 news.
Yeah, down with 24/7 news. If you look closely, you can actually see that, I guess, since Kennedy, that's what we're looking at here, the sitting president has been viewed unfavorably by more than half the country, almost half the time, 45% of the time. And by the way, Congress has been hated even worse. No one seems to like Congress, which is funny because the Congress people are supposed to be much closer to the population. You'd think that they would... Again, politics aside, but interestingly, this reality that we've had for over half a century, where in general, pretty much half the country is pretty unhappy with the president. If the president rated in the polls between 35 and 50%, which is not a very high approval rating, the markets actually performed pretty well. Those were good times. So I guess that no matter how you feel about our new president, don't worry about it. If you're concerned that everyone is unhappy, that just may be an okay sign for the stock market.
Exactly. It's just part of a democratic republic where you have equal representation of lots of different interests. You're not going to be happy with everything.
Mm-hmm. Okay, let's talk about something that's maybe a little bit more touchy, which is this issue of the national debt, which has been going up and up. And certainly there are people that will talk to you about the fact that literally we've added trillions and trillions of dollars to the national debt. And a lot of people, especially retirees, are worried about their Social Security. And young guys like us also are saying, wait a second, how is the Social Security Administration going to pay what they owe us? In fact, that report they send you, it's like a big page folded in half, 4 pages.
Yeah, your
on
annual
the very
statement.
front page, it says that in a few years, Social Security will only be able to pay 75 cents on the dollar, something like that. And especially now with the change and really the difficult political situation, do retirees need to be worrying? What should they be doing?
Well, I think what they say about Americans is that they'll do the right thing only after they've exhausted all of their options. I think it was Churchill that said that, actually. And I think that's what we're dealing with Social Security. There are a lot of I call them simple fixes, but fixes that will shore up the system, raising the retirement age, doing additional means testing, things, changing the benefit formula, a lot of things that will make it much more secure for younger generations. But for baby boomers, I think for the most part, there shouldn't be a lot of worry as to whether those benefits are going to be paid or not.
So you feel pretty confident that people are going to get the money that...
I do. No, I'm 49, and for me, I'm probably on the bubble of some of those reforms. But I think if you're a baby boomer, you should be pretty safe that you're going to get the benefit that you've paid into for years.
Yeah. So, okay, maybe I'm a little bit more pessimistic because, first of all, a lot of the people who I work with are Americans who live outside the United States, and because they receive a foreign pension, in fact, they may be living in Israel, for example, receiving a foreign pension, their Social Security will be cut under a provision called the windfall elimination provision, which actually means that no matter what you thought you were going to get $2,000 a month, it may be only $1,000 a month because you're getting another pension. So I always tell people, A, you have to be aware of WEP, the windfall elimination provision, and secondly, you have to be aware that it's not a huge amount of money that you're getting anyway from Social Security. So you need to have something more. You've got to be saving. And
but you make a really good point in that the changes that will be coming, most likely the easy pickings are those that are means tested, where people either have substantial assets, they have substantial incomes, and it's easy to justify lowering their benefit as a result. So that is the easy picking. So if you're in that category, you do want to be aware of that. And then your final point, at the end of the day, I would look at Social Security as a great benefit and subsidy, but you got to take care of your own house and do the best to have your own house in order to be able to support yourself and not rely 100% on Social Security if you can help it.
Mm-hmm. So what would you say is the number one thing that people who are planning to retire, let's say in 10 to 20 years, what should they be doing at this point?
Well, it's that normal, blocking and tackling of building financial wealth through earning more than your spend and saving over time. But it's also, I think, especially if you're that far away, this concept of working during retirement, seems like it's a penalty because you messed up and it's what you have to do, right? But what I have found in my practice is when you're retiring in your 60s, you still have a lot of gas left in the tank. And retirement is becoming more about working more on your own terms than not doing anything. And I think that's an important solution.
Are you going to build that into someone's financial plan, or are you just going to say that's the icing on the cake?
I think we build them into plans. We help people think about how do you glide into retirement by finding ways to generate income that give you more time freedom. Because ultimately that's what people want in retirement, is they want more freedom to do things that they enjoy outside of the daily grind. And the sooner you're more intentional about thinking about developing that, the more options you're going to have when you ultimately get to that time in your life.
Yeah. Roger, I'm not 100% with you on that one. The principle is perfect. Why stop working when you're 60 or 65? Hopefully you're healthy and you have decades more to go. But if you plan on it, that's where I worry. I've read studies that people who plan on working, when they hit 67, all of a sudden they go, I just don't have the strength. And I have no idea about the health issues, but I don't think I would plan on it. Instead, what I would do is I would say, listen, let's plan on you're not working.
We should have to plan financially that you have a safety net. Just like you're in your 40s, you have to plan for the possibility of not being able to work with disability insurance and things like that. So I totally agree with you. There's risks there, but there's risks with everything.
Yeah, but the risk, I think it's a different level of risk when you're talking about someone who's 70 and all of a sudden it turns out that he thought he was going to earn $10,000 a year more, working at Walmart, but it's difficult for him to do that at this point. Or at that time, Walmart no longer exists, but who knows? I also think another thing that's interesting is just to realize that the government, I'm trying to make people feel a little better about Social Security. The government is still pretty big and the American economy is still pretty big. The U.S. government brings in trillions of dollars in tax revenues every year. So although the obligations in Social Security also are growing, it's not like this is a company that's puttering along. The U.S. economy, good days and bad days, is still pretty robust, and I think that over time it's going to be better. And I'm just a little bit optimistic that the legislature is going to think about this a little more and maybe do some of those small changes that you had mentioned before, small changes that could just improve the situation, whether it's taxing earnings a little bit more. Not that I'm very against taxes. Let's say they change the benefit formula a little bit, or they tell people that you have to work one more year. Just that little difference would make a huge change in the Social Security pool. So there really are changes that the government can make if it looks like it's getting worse. So maybe we don't have to worry about it too much. All right, let's look at I think it's our last slide here, because I think it's actually very interesting, that people will often worry about the volatility, and certainly recently we've seen a huge amount of volatility in the run-up to the election, related to the election, but even months before there was volatility. How bad is volatility to someone's retirement portfolio?
Well, I think volatility is part of the price of investing. That is the big price of investing, is you're going to have to endure periods of uncertainty and losses on paper. And I think in retirement, if you're selling at the wrong time because you haven't created tripwires on your balance sheet of cash reserves, then it can be a big issue. But if you're a longer-term investor, that phrase that we hear all the time, you have to be a long-term investor. Well, the whole point of that phrase is if you have a 5-year timeline, then the day-to-day, year-to-year volatility ends up being not that important because you have enough margin to work through it. It's when you're dependent on selling something at a particular time when you can find yourself in a bind.
Yeah, I think that goes back to, the concept that we talk about a lot is having an emergency fund. But you need an emergency fund in case there's an emergency. But I think when you're in retirement, it's not a question of an emergency fund. It's a question of having one bucket, one piece of your overall portfolio in readily available cash, bank deposits. I know today people always say to me, oh, but Doug, the bank pays 0%. You want me to earn 0%? And the answer is, no, I don't want you to earn 0%, but that's the cost of liquidity. You're paying for the service of having money available to you at any point so that if the market crashes, you don't have to sell your stocks at the very, very bottom.
Yeah, that's really where your return comes from on the liquidity. It comes from having the money available so you don't have to borrow and pay interest. So you don't have to sacrifice your lifestyle to cut your expenses to cover whatever the new expenditure is. And the return on investment comes from not having to sell when you have bad markets. So, the RRI is calculated a little bit differently when you're talking about cash reserves.
Let me just remind people, because it's sometimes hard to see the slides here. You can download, just down below the video here, we have a download button, so you can download the presentation and look at it a little bit more closely. Roger, let me discuss a little more of this volatility issue, because a lot of times people say, well, once I'm retired, I certainly shouldn't have money in the stock market because I might lose it. What do you think?
Well, it goes back to the monies that you have in, say, the stock market aren't for your life in the next year or the next 2 years or really the next 3 years. It's your hedge, your major hedge against inflation, which is if you retire at age 60 and you live to age 90, you're going to have something invested that will preserve its purchasing power over and above inflation. And equities, stocks, traditionally have been the best asset to do that.
Mm-hmm. Yeah, I think actually if you look at the chart that we have here, the volatility, that is called volatility does not equal a financial loss unless you sell. It's such a critical point. There was a study that, if we look more closely here, going from over a 35-year period, during that, there was almost every year, there was a 5% or more decline. 5% these days on the Dow Jones is like 1,000 points. That's a huge drop. In fact, the average, what we call intra-year decline, meaning what happened within the framework of 1 year, was around 14% at some point. It means that you had a up and a down and up and a down. You had downs. It happens, but the people that held on over the long term saw 29 out of those 35 years were positive. In fact, I think they had an average return of around 11%. So obviously, and of course the disclaimer is, past performance is no guarantee of future returns. And just because we're showing a chart here, it doesn't mean it's going to happen again. But I think the logic that everyone has to realize is, if you have the tolerance for risk, and if you meet with a financial planner who recommends putting a piece of the portfolio in the market, see that piece of the portfolio as long-term money. And know right at the outset, you're going to have times when it may drop 5% or 10% or even much, much more, but you have to ride through that. And if you can't stand it, if you can't stand those kind of drops, then no matter what we say or whatever your financial advisor tells you, don't be in it at all. It just doesn't pay. You're gonna have a heart attack, and I guess that then you won't need the money. That's not good financial advice, though, Roger, is it?
Well, the cost of that is then you're going to have to sacrifice potential lifestyle because you're not going to have the inflation head and the possible returns to make up for not having for that safety that you want. There's no free lunch. Mm-hmm. So that's going to be the cost of that. And that's okay, but it's important that you make that decision intentionally. Right. I think the takeaway from this is it's okay to be in the stock market when you're retired. Understand what the risks are. Understand that you and your spouse, by the way, have the tolerance for that kind of risk. I'll leave you with this, then let's wrap up. There was a great quote by Warren Buffett in 2009. Just like everyone else, he got crushed. He's heavily in stocks. His portfolio dropped, and one of the newscasters said, so kind of like a wise guy, "Oh, Mr. Buffett, how does it feel to have lost 40% of your lifetime accumulation of capital?" 40%. And Buffett just, I don't think without losing a beat, he said, "Well, it feels pretty much the same as the previous 3 times this happened to me." He's still one of the richest men in the world. So holding on and developing a retirement portfolio that includes stocks, includes a very heavy cash position, which I think is something that when you're retired, not necessarily when you're 10 to 20 years out, but I think those are critical takeaways regardless of who's sitting in the White House. Totally agree. At the end of the day, you focus on the things you can control. And that really takes you a long way to creating a great life. All right, Roger, let's wrap it up there. Just tell people in the last few seconds, how can they learn more about you and follow you? You bet. I'm at rogerwhitney.com, and I have a podcast called The Retirement Answer Man, where we noodle on this idea of how do we create a great life today and still feel comfortable that tomorrow's going to be taken care of. Let's hear it for tomorrow. And my name is Doug Goldstein. I'm a financial planner based in Israel. I specialize in working with people who live outside the United States who have U.S. retirement accounts, IRAs, 401ks, brokerage accounts, bank accounts, which these days is sometimes a little bit difficult when you live outside America but want to have an American account. And you can reach me at profile-financial.com. Roger, thank you very much for joining me, and thank you all for joining us on the webinar. Stay in touch.